Welcome to Section 2 of the ASC 323 training series on the equity method and joint ventures. In this section, we cover the essential vocabulary, how the investment is measured when you first acquire it, and how the carrying balance changes with every reporting period. These mechanics are the heartbeat of the equity method. By the end of this section, you will be able to define the core vocabulary of equity method accounting, record the investment at cost on day one, handle a step acquisition where you cross the significant influence threshold, and apply the period-by-period adjustment formula. You will also understand one of the most commonly misunderstood rules in this area: why dividends from an equity method investee reduce your investment balance rather than showing up as income. Let us start with the vocabulary. Before we work through the numbers, let us nail the vocabulary. An equity method investment is your ownership interest in another entity where you have significant influence, and it appears as a single-line item on your balance sheet, not a list of the investee assets and liabilities. The investment account is that balance sheet line. It starts at what you paid and then moves up and down each period based on your share of the investee earnings, losses, and dividends. Equity in earnings is the income statement line, where you recognize your proportionate share of the investee net income. These three items work together every reporting period. Here is the key thing about basis differences. When you pay more than your proportionate share of the investee book value, that excess is a basis difference. Think of it as a mini purchase price allocation. You identify which of the investee assets or liabilities are worth more or less than their book value, allocate the excess there, and put the residual into goodwill. Then, over time, you amortize the portions allocated to finite-lived assets against your equity in earnings. The goodwill piece is not separately tested for impairment. It stays embedded in the investment and is assessed at the investment level. Two more terms you will encounter constantly. Upstream and downstream sales describe the direction of intercompany transactions. If the investee sells goods to you, that is an upstream sale. Any profit on those goods that has not been realized through a sale to a third party must be eliminated from your share of investee earnings. If you sell goods to the investee, downstream, you eliminate the unrealized profit from your own income statement. Suspended losses apply when the investment balance hits zero. You stop recognizing losses at that point unless you have guaranteed the investee obligations or intend to provide further financial support. The equity method starts simply. On day one, you record the investment at cost, the amount you paid to acquire the ownership interest. That purchase price becomes the opening balance of your investment account. Everything else we discuss builds on top of that number. Now here is where it gets more nuanced. If you paid more than your proportionate share of the investee book value of net assets, you have a basis difference. You need to allocate that excess to the identifiable assets and liabilities of the investee, essentially performing a mini purchase price allocation, and carry the residual as embedded goodwill. The surprising part of initial measurement comes when you already own a stake in an entity, and then buy more shares that push you over the significant influence threshold. This is a step acquisition. When that happens, you do not simply start the equity method from the new purchase date. You are required to retroactively apply the equity method from the date of your original investment, as if you had always been applying it, provided that is practicable. Any difference from what you had previously recorded under a ASC 321 flows through retained earnings as a catch-up adjustment. The prior investment balance gets reclassified to the equity method carrying amount. After day one, the investment account is adjusted every reporting period using this formula. You start with the opening balance, add your proportionate share of the investee net income, subtract any dividends you received, subtract the amortization of basis differences for the period, and subtract any impairment you have recognized. The result is your closing investment balance. Each component of this formula has its own accounting entry, and together They tell the full story of how your economic interest in the investee has changed. Let us walk through each component in detail. When the investee earns a profit, you recognize your proportionate share by debiting your investment account and crediting equity and earnings on your income statement. When the investee reports a loss, you reverse that debit equity and loss, credit the investment account. But loss recognition has a floor. Once your investment balance reaches zero, you stop recognizing further losses unless you have guaranteed the investee obligations or committed to provide additional financial support. One more thing that is easy to overlook. If the investee has items of other comprehensive income, you pick up your proportionate share of those too, running them through your own other comprehensive income. Watch out for this one, it trips up even experienced accountants. Under the equity method, dividends are not income. When the investee declares and pays a dividend, you debit cash and credit the investment account. The investment balance goes down. Nothing hits your income statement. The logic is straightforward once you understand it. You already recognized your share of the investee earnings through equity in earnings when the investee earned the money. When it pays a dividend, it is just returning some of that value to you. Recording it as income again would be double counting. This is one of the sharpest contrasts between the equity method and the cost method. The last regular adjustment to the investment account is the amortization of basis differences. If you allocated your excess purchase price to, say, the investee proprietary technology with a 10-year life, you amortize that allocation over 10 years by reducing your equity and earnings each period and crediting the investment account. Assets with indefinite useful lives are not amortized. They are subject to impairment testing instead. Embedded goodwill falls into this category. The amortization of basis differences means your equity and earnings may be lower than your raw ownership percentage times investee net income, and that difference matters for financial analysis. Let us bring this section together. You record the equity method investment at cost on day one and allocate any basis difference to identifiable assets and residual goodwill. If you cross the threshold through a step acquisition, you apply the equity method retroactively. Each period you adjust the investment balance for your share of earnings, deduct dividends received, and subtract amortization of basis differences and any impairment. And remember the most important rule of this section: dividends from an equity method investee reduce your investment balance. They are a return of your investment, not income. Thank you for completing this section on initial and subsequent measurement. Thank you for watching. Subscribe for more training from PNJ Group.